Yeah, understand everything you're saying that, about Netflix, Alphabet, and Facebook. And I'm a Facebook shareholder. I think it's a great company. I operate in country towns in Australia, and we advertise on Facebook, promote our business there. So you just think that's going on everywhere. What I don't really understand is how Alphabet and Facebook trade on multiples of like 20 times, and yet a Netflix trades on a multiple of 60. I understand the valuation you talked about per user and all that kind of thing for Netflix, but that is such a huge differential to me as a newbie. I don't understand why there's such a huge difference between those.
Yeah.
I'm not sure if my numbers are exact there, but both Facebook and Alphabet are about 20 times earnings, and Netflix is sort of a lot more than that.
Yeah, well, Netflix is only recently even started to turn profitable. So, Netflix, I'm taking a quick look at it right now on Capital IQ, is trading at 102 times earnings, 76 times EBITDA. So, if you look at a price to revenue multiple, it's not as out of whack. Netflix is a little under 9 times revenue. And here, let me just pull up Facebook. Glenn, you just had the slide up. On a revenue basis, Facebook is trading at 7.3 times. So look, Facebook at 7.3 times revenue, Netflix at 8.7 times revenue is actually a fairly narrow gap. So what the difference though is Facebook is monetizing like crazy right now, whereas Netflix is still in very heavy investment mode, both in terms of content as well as in terms of international growth. So Netflix really still is not trying to be profitable at this point. They have huge cash flows, but they're taking basically all of it and reinvesting it back in the business, i.e., and therefore reporting very little profitability. In Facebook's case, Facebook is a better business model than Netflix, to be clear, because all of us, the users of Facebook, provide the content. Facebook doesn't have to pay for it. Same thing with Google. Via our searches, we're providing them the content. Whereas Netflix has to buy content. They either have to license it or develop it themselves, and that's a huge cost. That's why they have negative cash flow and have actually been issuing debt, because I guess they don't want to issue equity. I've been begging Reed Hastings to issue equity, not debt, in order to fund this, given the high price of their equity. He has so far ignored me on that one. But look, so I think the main difference is you can't really look at current profitability because Netflix is still in a land grab mode, whereas Google and Facebook, I think you can look at current profitability. They're just better, higher margin businesses, so they can both grow like crazy and be highly profitable, and you can value them. So that's sort of like, as a value guy, that's sort of why I lean toward Google and Facebook. But look, Netflix, the period of time in which I've been doing that, Netflix has far outperformed because it's just been growing a lot faster. Well, I mean, Netflix and Facebook have both been growing at about the same rate. Facebook's growth rate has now come down a bit. Netflix is still a little higher. So, I think investors are looking out 5 to 10 years on what Netflix's profitability will be like as a more mature, slower growing business, whereas you can see the profitability on Facebook and Google right now.
You know what, Nick, though I think your point is well taken, and you don't have to buy Netflix. You don't have to buy anything, but perhaps, in the context of another leg of the valuation stool being proven out by PE, well, that means that Google and Facebook pass the screen and Netflix doesn't, and that's fine. Netflix is a challenging one to value. Amazon's a challenging one to value. If there was certainty, this game would be a lot easier. By the way, Nicholas did ask a question about Netflix debt. Whitney, he mentioned it slightly, but is Netflix debt level something you're concerned about? Yeah, it is, because I don't understand why they're doing that. I don't understand why they don't simply just put some equity out there and delever. There's enough risks in that business that you don't want to have a balance sheet risk either. Look, it doesn't have any short-term maturities, but it's just not the right way to capitalize it, in my view.
Yeah, so let's just take a quick look at, I'm pulling up now Netflix on Capital IQ here, and let's just go back, one or two more years here. The reason I'm ducking is because the camera's right in the middle of my screen, so I sometimes can't see what I'm looking for. But let's just click, again, the same thing we did yesterday for McDonald's. Let's click cash from operations of Netflix. And then, and yeah, well, the thing that's tricky about this is here. Let me map net income, other operating activities, which is going to be a function of adding to the streaming content library. So that would be down here. So watch what I'm doing here.
Excuse me.
Okay, so let's just map these right here. All right, so here you can see what's going on. Net income is rising nicely, but cash from operations is falling substantially, and the reason for that is their addition to streaming content assets, which you can see is really exploding to the upside. Heck, they're not letting me map this. Hold on. Other operating activities. Here we go. They should let me map this. Okay, here we go. So this is other operating activities from the cash flow statement, and this is almost entirely additions to their streaming content. And so as a result of this, since they're not generating enough net income to cover this, their debt level is going up. So now let's scroll over, go over to the balance sheet. And this is the last, let me add a couple more years here. And let's just scroll down and take net debt right here and chart that. And you can see that Netflix's net debt has gone from this would be a cash position right here. They had $722 million of net cash 4 years ago, and now that's ramped up to $5.2 billion of net debt. But keep in mind, this is a company with $130 billion market cap. So $5 million of net debt is just sort of a rounding error here. And you can see that the profitability, let's just go over to the income statement and just take profitability. Let's just take operating income. And you can see operating income for Netflix, which was fairly minimal, has really started to accelerate. So look, operating income of $1.7 billion on $5.2 billion of net debt. Even if this were sort of a normal, smaller company with a smaller market cap, you know, that's a pretty reasonable number. What's that? 3x debt, net debt is 3x trailing 12-month operating income. But then you factor in their $130 billion market cap, and at any point they could just do a very small equity offering and wipe out all their debt. You know, that's what they should do. That's what they should have done when the stock was back at $350 to $420 a share. And in fact, I wrote an article, which I'll send to you guys. It was an open letter to Reed Hastings in the same spirit of the article that he wrote to me years ago about cover your Netflix short now. I wrote an article to Reed Hastings and then put a PS in an article and said also same message to you, Elon Musk, which is take advantage of your richly valued stocks and issue equity to pay down debt, eliminate the debt, and build a big cash hoard. Mike, I see, let me unmute you and go ahead and ask your question.
Yeah, I had a question for Glenn about Facebook. You talked about the different valuation of U.S. versus the international users as far as monetization. Is that a factor of just where they are in their maturities, and are they growing at the same rate as the U.S. was when the U.S. was the primary market?
You know what, Michael, that's a terrific question. And if you look at those charts, you can see that the growth rates in those other geographies are actually healthier than they are in the United States. You know, sort of year over year, those growth rates are higher. It's a combination. I would not expect the rest of the world ever to get even up to half of the U.S. Based on a lot of factors, including the affluence of the world versus the affluence of the United States. So, and there's many geographies where Facebook is not even close to you know, the dominant you know, China as an example. I wouldn't expect it to be. I would expect Whitney. What's the Chinese social media site? Weibo?
Yeah, Weibo, and there's, you know, Baidu, Alibaba, and that gets to one of the questions actually on the chat line. A couple people have sort of said, you know, long-term future, how do you think Google and Facebook compete with the Chinese giants, number one, in terms of the international growth opportunities? You know, could that be a headwind for them? And then two, how would you compare, you know, Alibaba stock looks cheap, Weibo stock looks cheap, you know, the Chinese companies have come way back down, you know, how might you compare those investment opportunities? Any thoughts on those?
Yeah, so let me just finish up with Michael. I think that the you know, there is plenty of stickiness to these platforms. So there's a huge value embedded in the United States. The stickiness in the rest of the world is less and growing, and the opportunity upside is growing. You know, out of those 2.3 billion users, you know, the majority of them are outside of the United States. So to get the sort of growth numbers that we're thinking about, you don't need a whole lot more upside there, plus the organic U.S. growth from the incremental advertising spend and their other products. So, you know, in situations like this, we're not trying to pinpoint intrinsic value. We're trying to pinpoint that it's going to be worth more in 2 years, because if we're right in the growth, you know, that's not even close to suggesting they're going to get to $28, you know, per quarter in the rest of the world. But I don't know where it goes to. I do think that, you know, the prospect that it's 50%, it's a 50% larger company in 2 years as a result of those factors, I think is pretty high.
Pretty high.
And that's where that's sort of where the calculus comes from.
Right.
Major Asian competitors, I would say that the stickiness in the U.S. of Facebook, you know, is the same stickiness in Asia for the social media people that have the first mover advantage there. So I think that market shares today for the existing platforms will more than likely perpetuate. So, you know, I don't think that a Chinese social media company is going to do particularly well in the United States, supplanting Facebook, but I don't think that Twitch is going to supplant Huya in China. So I think it's a much more broad, complicated question to get involved in the valuation of the Chinese companies. I personally have an issue with the corporate governance associated with those companies, not the least of which is you don't own a share of the business. When you own a piece of stock in Alibaba, you own a share of an intermediate company that tracks the stock. So that's a little bit more far removed. And in bull markets, that doesn't matter. In bear markets, that's a huge issue. But I'm not particularly prepared to, you know, to opine on Alibaba other than the fact that it's a lot cheaper than it used to be. You know, same thing with Tencent. And if I was going to be dipping my toe over there, that's where I would be going, is in the mega ones that have been cut way back. But when we looked at Alibaba a couple weeks ago, Whitney, you know, yeah, it's way down, and yeah, it's not cheap.
Yeah. I'm just pulling up. Let me show you guys what I'm looking at here in terms of Capital IQ, and, you know, just taking quick looks at stuff. There you go. So let me first just highlight a couple quick things. Here is one thing to look at is, in terms of thinking about future growth potential and all, Netflix here has $15 billion of trailing 12-month revenue. Facebook is $52 billion. Google is $130 billion, right? So, and then Apple's, $260 billion. So roughly speaking, Apple has double the revenues of Google / Alphabet. Facebook, Google is 2.5 times, almost 3 times the size of Facebook, which is in turn triple the size of Netflix. So one of the things, investors are thinking about is size is an anchor to growth. Netflix is, just has I would argue, has a much longer, higher percentage growth runway than the other ones. Facebook is sort of second. Again, it's just smaller. And there's still so much room to monetize. And I would echo what Glenn said is, the Chinese giants have grown out of a completely protected market in the largest population country in the world. But almost no Chinese companies have managed to successfully sort of innovate and develop brands where they've been able to be real successful going outside of that completely protected market. And so my money is as the second half of the world's adult population gets a smartphone, mostly in lower income countries, India, Sub-Saharan Africa, Latin America, I think they're going to be getting Android phones, not Apple phones, and virtually all of them are going to be using that suite of 7 Google products that have 1 billion MOUs monthly, and I would bet almost all of them are using Facebook. It's not clear to me that they're going to be buying many Apple phones. I think that that becomes a much slower growth business, more of a replacement business in the developed world. And it's not clear to me that Chinese giants are going to be really monetizing, Latin America, Sub-Saharan Africa, or much of India. So a quick look here. I'm just going to pull up Alibaba and just, because I know some people who like this, and just let's take a quick look at it real time. I haven't prepared any slides on it or anything like that. So Alibaba, the stock has come, hold on just a second so I can see my screen here. So the stock has pulled way back at $136. It's come down from $211. So, it's down by 40%. Still got a big $350 billion market cap, 40 billion of revenues, trading at 9 times revenue. So that's the highest revenue multiple of any of the ones we've seen. But really, really profitable. 39 times EBITDA, 43 times earnings. So I don't know. I've always viewed China as too hard for me, as outside of my circle of competence. I know too many people who've gotten defrauded in China. So I don't know. Let's take a look at Tencent. There's a way you can own Tencent through a South African company called Naspers. That's a very popular way to play it, by the way. So Tencent here, again, like most of the Chinese companies, stocks down here 40-something% from $61 to $34 a share. 40 billion in revenues, trading it at 8 times revenues, highly, highly profitable. I think they're interesting. I sent you guys the write-up of Weibo that was just posted on Value Investors Club. I think they're interesting, but it's just like, wait, I can buy Google and Facebook, which I think are much better positioned to capture that international growth outside of China. And they're trading at lower revenue multiples. And I don't have all the China risk. The Chinese government, if one of these companies sort of falls out of favor with, for whatever reason, with the Chinese government, there's just such tail risk there that there's a little bit of tail risk with Google and Facebook, and the European Union and or the United States could take some regulatory action. but I would argue it's nothing like the tail risk of the big Chinese companies, or of any Chinese company, honestly. Let's see. Daniel writes, Baidu, some challenges, but 18 times PE, PEG of 0.88. So let's pull up Baidu and just take a quick look. So Baidu, like most of the Chinese stocks, is down, 35%. It looks like 183 down from 284. It's much smaller, $14 billion in revenue, trading only 4 times revenue, 12 times EBITDA, 15 times earnings. So certainly looks cheaper. Do you have anything? Do you have any, Daniel or Philip? You have anything you want to add on Baidu? I personally have never really spent a lot of time doing a deep dive on the Chinese companies, just because I felt real circle of competence issues, and I know too many people who've gotten blindsided there. Michael, do you want to have any comments on that? I noticed your video's live.
No.
Okay.
No, I just don't. I think it was left on after I had asked a question of Glenn.
Understood. Okay, I'll put you back in the queue. Any other thoughts, Glenn? By the way, the sun is coming through your window and putting funny spots on your face. Anyone else have any other chat questions? Let's just review the chat line, Glenn. I'm reluctant to launch into another big module with 6 minutes left of our session today. I thought it was fun taking a look at both historical and current tech stocks. Let's see. Glenn, did you have any comment, Michael, or maybe you already covered this and I missed it. Are Europe and Asia's lower monetization growing at the same rate as the US was at the same time in their maturity? I've never gone back and tracked that. That'd be an interesting project. In fact, I'm going to write a note and have our analyst, Kevin, go back and see if he can produce a nice little chart. And it would be sort of cool to see that Europe is on the exact same trajectory in terms of monetization that the US was, 5 years ago. Anything you want to add to that, Glenn? You're muted.
Nope.
All right.
But I fixed the sun.
Okay. Let's see here. Let me then just put up just the next module that we'll start to cover next time, which is value traps. So we're going to pivot from looking, at great companies that